Good day, everyone. I'm Jingwen from Group 7 So A. Today, we are going to present Chapter 16, Auditing the Financing/Investing Process, Cash and Investment. Firstly, I will explain the relationship of the various business processes to cash. Cash reported in the financial statements represent currency on hand and cash on deposit in bank accounts, including certificate of deposit, time deposit, and saving accounts. While cash equivalents as short-term, highly liquid investments that are readily convertible to cash and so near their maturity that there is little risk of change in their values. For instance, treasury bills and money market funds. Then, what is the effects of major accounting transaction on cash? When we operate a business, we will receive cash received and make payment for purchases and expenses. The main resource of cash received include the revenue process, where we receive revenue from customers after providing goods and services. The sales of property, plants, and equipment, where we receive payment from acquirer. And the proceeds from issuing long-term debt or capital stock, where we can receive cash or capitals from debtors or investors. While the main resources of disbursement of cash include purchasing process, which is mainly for acquisition of inventory and property, plants, and equipment. Human resource management process, which make payroll payments to employees and payment on long-term debt and repurchase of stock, where we make payment to creditors or purchase treasury share. There are three types of bank accounts, which are general cash account, impressed cash account, and branch account. General cash account is the main cash account for most entities and the only cash account maintained for many small entities. The major source of cash received for this account is the revenue process, and the major sources of cash disbursement are the purchasing and human resource management process. Impressed cash account contains a stipulated amount of money to be used for a specific purpose. The separate impressed account are frequently used for disbursing, payroll, and dividend check. For instance, fund transfer from the general cash account to the payroll impressed account. The payroll is then drawn on this impressed account, which reduces the impressed account balance back to a specific minimum account amount required to keep the account open and active with the bank. It can minimize the time required to reconcile the general cash account and help to maintain adequate control over cash. The company that operate branches in multiple locations may maintain separate accounts at local banks. This account is called a branch account. This allows each branch to pay local expenses and to maintain a banking relationship in the local community. The branch used to submit periodic cash report to headquarters and receive a check or transfer from general cash account and record both cash receipt and cash disbursement. Then, we will proceed to control risk assessment. The close relationship of cash to the revenue and purchasing processes, issue relating to the inherent and control risk for cash. The auditor assessment of inherent risk and control risk for transaction process through the revenue and purchasing processes strongly affect the nature and extent of testing for the ending cash balance. For example, incoming checks are to be restrictively endorsed and daily cash received from customers are to be reconciled with posting to the account receivable subsidiary ledger, while outgoing checks are to be signed only by authorized signers and only after all documents included in the voucher packet have been independently approved. These control activities provide strong evidence that the completeness and authorization assertion. After that, monthly bank reconciliation is a major control for entity personnel who are independent of the handling and recording of cash receipt and cash disbursement. It ensures that the entity's book reflect the same balance as the bank after reconciling item has been considered. If the entity has good bank reconciliation procedures that are promptly performed, the auditor may choose to test the entity reconciliation procedure as part of testing control and thereby reduce the audit work on the ending cash balance. Then, I will pass it to Julia to continue the presentation.
Thank you, Jingwen. Good day, everyone. I'm Julia Cocking from Group 7. Now we are going to talk about the substantive analytical procedures of auditing cash. You will learn about the test of details of transaction and account balance used to audit cash. Cash does not have a predictable relationship with other financial statement accounts due to its residual nature. As a result, when auditing cash, the auditor's use of substantive analytical procedures is typically limited to comparison with prior year's cash balance and budgeted amounts. This limitation of substantive analytical procedures is normally offset by, first, extensive tests of controls or substantive tests of transaction for cash receipt and cash disbursement. Second, extensive tests of entity bank reconciliation. Let us have a look at this table 16.1. The table of 16.1 shows the examples of substantive tests for both cash receipt and cash disbursement. The auditor obtains significant evidence of assertion related to cash account by testing cash receipt and cash disbursement. Most audits include substantive tests of transaction for both cash receipt and cash disbursement, as well as control tests for the revenue and purchasing process respectively. First of all, for the occurrence of cash receipt, we need to validate a sample of cash receipt journal entries against remittance advisors, daily deposit slips, and bank statement. For cash disbursement, we need to vouch a sample of cash disbursement journal entries against cancelled check, voucher packets, and bank statement. For completeness of cash receipt, we need to trace a sample of remittance advisors to cash receipt journal and if necessary to deposit slips. For the completeness of cash disbursement, we need to trace a sample of cancelled check to the cash disbursement journal. Next, we move to the authorization of cash receipt. We need to examine the signature on the deposit slip and the check endorsement for proper authorization for a sample of days. Then for authorization of cash disbursement, we need to examine a sample of cancelled check for authorized signature and proper endorsement. For the accuracy of cash receipt, we need to put the remittance advisors and entries on the deposit slip for a sample daily deposits and agree to the cash receipt journal and bank statement. For sample of weeks, put the cash receipt journal and agree posting to the general ledger. For the accuracy of cash disbursement, agree on amounts in purchase order, receiving report, invoice, cancel check and disbursement journal for a sample of voucher packets. For sample of weeks, put the cash disbursement journal and agree posting to the general ledger. For the cut-off of cash receipt, we need to compare the dates for recording a sample of cash receipt transaction in cash receipt journal with the date the cash was deposited in the bank. Observe cash on hand for the last day of year and trace deposit cash receipt journal and cut-off bank statement. For cut-off of cash disbursement, we need to compare the dates for a sample of checks with the dates the check cleared the bank, record the last check issued on the last day of the year, and trace the cash disbursement journal. For classification for cash receipt and cash disbursement, examine a sample of remittance advisors for proper account classification. These substantive transaction tests are frequently conducted as dual-purpose tests, that is, in conjunction with tests of controls. Instead of taking samples, auditors in IT settings may be able to use audit data analytics to test the entire population of cash receipt and cash disbursement. Then let's move to table 16.2. Table 16.2 summarizes the assertion and test of cash account balance details. For assistance, accuracy, valuation, and allocation of account balance at period end, we need to confirm bank account balance with financial institution, test bank reconciliation for each account, put the reconciliation and the outstanding check listing, trace balances per book to general ledger, obtain standard bank confirmation and trace balance per bank to the bank reconciliations, obtain cut-off bank statement, trace deposit in transit, outstanding checks, and other reconciling items to cut off bank statement. If control risk is high or if fraud is suspected, perform extended bank reconciliation procedures, perform a proof of cash, test for kitting. Kitting is defined later in the chapter. The assertion of rights and obligation is not included in table 16.2 because it is rarely relevant to the cash balance audit. The major audit procedures for each cash account include bank reconciliation tests. The approach to auditing a bank reconciliation is basically the same, while the general cash account, on the other hand, receives more detailed audit work because it typically represents a significant amount and has a high volume of activity. I will pass the time now to Chloe to explain more about the auditing of general cash account.
Thank you, Julia. A very good day to everyone. I'm Chloe Tam from Group 7. Just now, Julia has explained about the substantive analytical procedures of auditing cash. Do you know what documents need to be obtained by auditors when auditing the general cash account? There are three documents, which is bank reconciliation, standard bank confirmation, and cut-off bank statement. Now I'll explain each of the documents so that you have a better understanding about the purpose of each document. The first document is standard bank confirmation. It provides third-party written evidence on bank account balance and other information such as loan, lines of credit, security arrangements such as account restriction, or complex relationships such as derivative. It is used for auditor to verify bank account balance. The second document is a cut-off bank statement. It is a bank statement as of a date subsequent to the date of the balance sheet. The auditor obtained cut-off bank statement by having entity request that bank send the statement directly to auditor. The auditor obtained cut-off bank statement to test the reconciling item which is included in bank reconciliation. The third document is a copy of bank reconciliation. The bank account balance in an entity book of account could be different compared with the balance reported by the financial institution in the most recent bank statement due to certain factors such as bank service charge, outstanding check, and check return due to customer did not have sufficient cash. Therefore, entity need to identify the reason for the discrepancy and reconcile the difference, and bank reconciliation is used to reconcile the balance in bank with the balance in books. So how auditors going to test the bank reconciliation? First, auditors need to verify the mathematical accuracy of bank reconciliation to make sure that there's no error in calculation and agree the balance for the books to general ledger. Secondly, agree the bank balance on the bank reconciliation with the balance shown on the standard bank confirmation to see whether the amount is the same or not. Thirdly, trace the deposit in transit on bank reconciliation to the cut-off bank statement. Any deposit in transit should be listed as deposit shortly after the end of the period. Fourthly, the auditors have to compare the outstanding check on bank reconciliation with the cancel or substitute check in cut-off bank statement. Next, agree any charge included in bank statement to the bank reconciliation, for instance, bank service charge. Finally, the auditors agree the adjusted book balance to the cash account lead schedule. Next, I will pass to Cindy to explain about fraud-related audit procedures.
Thank you, Chloe, for the presentation. Hi all, I'm Cindy Stephanie, and now I will continue to present on fraud-related audit procedures. There are many types of fraud such as forgery or collusion, which are difficult to detect. So, if the entity does not have adequate controls over cash or the auditor suspects some type of fraud or defalcation involving cash has occurred, it is necessary to extend the normal cash audit procedures. There are three audit procedures used to detect fraudulent activities in cash accounts, which are extended bank reconciliation procedures, proof of cash, and test for cheating. Firstly, extending the bank reconciliation is essential when an unscrupulous client covers cash defalcations by manipulating the reconciling items in the bank reconciliation. This procedure is to examine the disposition of reconciling items included on the prior month's reconciliations and the reconciling items included in the current bank reconciliation. There are a few examples of reconciling items. For deposit in transit, the auditor will trace the deposits to the cash receipts journal in the current month to verify the recording, and it will also be traced in the bank statement of the following month. As for outstanding checks, they will be traced in the cash disbursement journal of the current month, and the cancel or substitute checks returned with the next month will be examined. Other reconciling items such as bank charges, NSF checks, and collection of notes by the bank would be traced to the accounting records for proper treatment. Further investigation required for the items not properly accounted for. A proof of cash is used to reconcile cash receipts and disbursements recorded on an entity's books with the cash deposited into and disbursed from the entity's bank account for a specific time period. Usually, proof of cash refers to four-column proof of cash as shown in the slide. It consists of the bank reconciliation for the beginning of the period, reconciliation of cash deposited in bank with cash received recorded in cash receipt journal, reconciliation of cash disbursed through bank accounts with cash disbursement recorded in cash disbursement journal, and bank reconciliation for the end of the period. The primary purpose of proof of cash is to ensure all cash receipts are recorded in the entity's cash receipts journal and deposited in the entity's bank account. Besides, proof of cash is to ensure all cash disbursement recorded in the entity's cash disbursement journal have cleared the entity's bank account. Also, it is to ensure that no bank transactions have been omitted from the entity's accounting records. And for your information, proof of cash will not detect a theft of cash when cash was stolen before recording in the entity's books. As for the test for kitting, kitting is a practice involving an employee trying to cover the cash shortage or theft by transferring money from one bank account to another and recording the transactions improperly in the entity's books. The employee performed this by preparing a check on one account before year-end but not record it as cash disbursement in the account until the next period. Then, the check is deposited as a cash receipt in a second account before year-end. This deposit is made near to year-end as the check will not clear the first account before the end of a year. The electronic wire transfers are recorded more rapidly than paper transactions. There is still a one-day delay and results in kitting to occur. Commonly, auditors will prepare an interbank transfer schedule to test for kitting. It is widely used although the control activities are adequate and no fraud is detected as the schedule provides the auditor with evidence on the proper cutoff for cash transactions. So that's all from me. Now I'll pass to Weibin to continue his presentation on auditing and impress account, petty cash fund and investment.
Thank you, Cindy. Hi everyone, I am Weibin. Now I will proceed to audit and impress account, petty cash fund and investment. Audit of any impress a cash account such as payroll or a branch account follow the same basics audit step under the audit of the general cash account, which are extended bank reconciliation procedure, push out cash, and therefore kiting. The document needed for the auditor is bank reconciliation, a standard bank confirmation, and a cut-off bank statement. In comparison, the audit testing for an impress account is less costly compared to audit of the general cash account for two reasons. First, if the impress balance in the account is generally not material, the company always maintains a minimum balance to keep the bank account active except for the short time after the deposit from the general account for payroll purposes and before the payroll disbursement have cleared. Second, the type of disbursement from the account are same. The check issued are for the similar type of transaction and relatively small amount. Next, we move to auditing a petty cash fund. Most entities will maintain a petty cash fund for paying certain type of expenses or transactions. The balance in the fund is not material. However, this fund is exposed to potential for defalcations because an entity employee may be able to process numerous fraudulent transactions through the fund over the course of a year. For the petty cash funds, external auditor infrequently perform substantive procedure except when the fraud is suspected. The internal auditor will document and perform tests of control over the petty cash fund. If the entity without an internal auditor, the external auditor may perform a limited test of control. The common control placed over the petty cash fund include use of pre-number petty cash voucher for withdrawing cash, Limiting the reimbursement amount can be made from petty cash. Account payable clerk should review the voucher for propriety before replenishment because the general cash account will reimburse the petty cash fund regularly. Last, there is an independent personnel of the cash function conduct a surprise count on the petty cash. After this, there are several important financial disclosures we must consider when auditing cash. The disclosure items for cash include accounting policy for defining cash and cash equivalents, any restriction on cash such as seeking fund requirement for the funds allocated by the entity board of directors for special purposes, contractor obligation to maintain compensating balance which we must pay more attention to confirm it, cash balance restricted by foreign exchange control, and letter of credit. The minute of board of director meeting, line of credit arrangements, loan agreement, and similar document is a primary source of the information for the financial statement disclosures. The entity often invests excess cash to earn a favorable return. The investment security includes equity security such as common and preferred stock, debt security comprise notes and bonds, and hybrid security can be convertible bond and stock. The accounting treatment for such instrument is affected by factors such as the percentage of the other entity on, the degree of influence exercised over the entity, the classification of the investment as a current or non-current asset, fair value consideration, and etc. On a general level, the auditor must assure that the amount shown on the balance sheet for the various type of investment are not material mistakes, and the related disclosures are complete and materially correct. In order to audit the investment, we need to refer back to the audit risk model. The inherent risk associated with the investment different due to the amount of activity, the complexity, and valuation of instrument. For example, the stock which is publicly traded is easy for an auditor to account for and audit. However, the more complex instruments have derivative and asset-backed security. These financial instruments require significant judgment of management in the value of input used in the determination of fair value on the reporting period. Due to the judgment and complexity associated with this type of financial instrument, the auditor is likely to assess the inherent risk as high. The auditor is likely to use reliance strategy when auditing the entity that hold the large investment portfolio to evaluate the internal control by the entity and perform the test of control to set the control risk below the maximum. However, for the majority of entities that do not require an audit of internal control over financial reporting, it is more efficient for the auditor to use a substantive strategy and perform a detailed audit of the investment security at year-end. That's all from my side. I will pass to Sujie to continue the control risk assessment of investment.
Thank you, Wei Bin. Hi everyone, I'm Sujie. Now I will proceed to control risk assessment of investment. The auditor must have a reasonable understanding of investment control even when a substantive strategy is used in order to predict the kinds of misstatement that might happen and organize the substantive procedures. Hence, here are some of the important assertions for investment, which are occurrence and authorization, completeness, as well as accuracy and classification. Now, let's have a look to the details of each assertion. The first assertion for investment is occurrence and authorization. The purchase or sales of any investment must be properly initiated by authorized individuals. Firstly, the entity should have adequate documents to indicate that a specific acquisition or sales of the security was properly authorized and initiated. This is because the auditor can use these documents to assess the validity of the transaction. Besides, the commitment of resources to the investment activities should be approved by the board of directors or by an executive who has been delegated this authority. It will be very simple for the auditor to verify the security transaction at the end of the period if the company has sufficient controls in place for initiating and authorizing security transaction. Next, for the completeness assertion, they must have adequate controls in order to assure that all transactions involving securities are documented, while the auditor are responsible to evaluate the design and operating effectiveness of the entity's controls. For example, the entity needs to maintain a security ledger that records all security owned by the entity and reconcile the subsidiary ledger to the general ledger control account regularly. The following assertion is about accuracy and classification. The entity should ensure that all security are appropriately categorized and the suitable price are used to accurately value the investments for financial statement purpose. Next, we will move to the key segregation of duties for investment. Proper segregation of duties is one of the most important control activities in any accounting system. However, only entities that engage in a significant number of investment activities are likely to have adequate segregation of duties for all investment activities. The first segregation of duty is the initiation function should be segregated from the final approve function. This is because fictitious transactions can be made or the security can be stolen if one individual is responsible for both the initiating and approving for security transaction. Next, the valuation monitoring function should be segregated from the acquisition function. This is because the security's value can be improperly recorded or not reported to the management if one individual is responsible for these both functions. Besides, the person who is responsible for maintaining security ledger should be separate from that of making entries in the general ledgers. If one individual is responsible for both security ledgers and the general ledger entries, that individual can conceal any defalcation that would normally be detected reconciliation of subsidiary records with general ledger control accounts. Lastly, the responsibility for custody of the securities should be separate from that of accounting for the securities. This is because a theft of the securities can be concealed if one person has access to both the securities and the supporting accounting documents. That's all from me, and I will pass to Chloe Ling to continue the substantive procedure for investment.
Thank you, Sujie. I'm Chloe Ling. As we discussed earlier that it is generally more efficient to follow a substantive strategy for auditing investment. The auditor can perform extensive substantive procedure to reach the planned level of detection risk when the control risk is set to the maximum level. Substantive analytical procedures are used to determine whether the investment and related income statement accounts are reasonable, while the text of detail is the substantive procedure used by auditor to gather the evidence of investment assertion. Next, here is some example of substantive analytical procedure that can be used by the auditor. The auditor can compare the current investment balance with previous years after adjusting for current year operating and financing activity. The auditor can compare the current year interest and dividend income with prior year and the expected return on investment, and they can also recompute the current year interest income using the face amount of security held, the interest rate held, and the time period held. Next, we will discuss the assertion of the investment account audit procedure. First, the auditor should perform at least one of the following audit procedures when gathering evidence of its existence. The procedure include physical examination, confirmation with the issuer, confirmation with the custodian, confirmation of unsettled transaction with the broker-dealer, confirmation with the counterparty, as well as reading executive partnership or similar agreements. Next, in terms of accuracy, valuation, and allocation, the auditor can perform the audit procedure as follows. The auditor needs to confirm that the initial acquisition cost of securities are recorded through verify the purchase price of a security by examining a broker invoice or similar document. The auditor needs to check that the debt
security that will be held to maturity should be recorded at the amortized cost through verify the purchase price of the debt security at the time of purchase and then use the effective interest rate to calculate the interest income. The auditor can obtain the fair value of equity security registered with the Security Commission Malaysia or trade over-the-counter market to verify the fair value of equity securities by tracing them to sources such as brokers or other reliable financial publications. Investments do not have fair value that can be readily obtained from the market data and thus require substantial judgment on the part of management. And it is also essential that the auditor need to determine whether there is any non-temporary changes to the fair value of the investment security. The following factors are indicators of a possible non-temporary decline in value. The factors include fair value is significantly below cost. Decline in fair value is attributable to specific adverse conditions affecting a particular investment. Decline in fair value is attributable to specific conditions, such as conditions in an industry or in a geographic area. Management does not possess both the intent and ability to hold the investment long enough to allow for any anticipated recovery in fair value. The decline in fair value has existed for an extended period. A debt security has been downgraded by a rating agency. The financial condition of the issuer has deteriorated, as well as dividends have been reduced or eliminated, or scheduled interest payment on debt security have not been made. In terms of classification and presentation, the auditor should ensure that debt securities are classified correctly as held to maturity, trading, or available for sale, because the misclassification affects both the balance sheet and income statement. In addition, all trading security must be classified as current asset in the financial statement. The classification of held to maturity security and available for sale security relies on whether the management anticipates that they will be converted into cash within 12 months. In evaluating management intent, the auditor should consider whether investment activity corroborate or conflict with management's stated intent. The table summarizes the audit procedure that can be performed on the investment account for balance and presentation and disclosure assertion. Firstly, to check the existence of investment, the auditor can inspect security if maintained by client or obtain confirmation from independent custodian. For rights and obligations, the auditor needs to examine brokers' advice for a sample of security purchased during the year, then determine whether there is any security have been pledged at collateral by asking management and reviewing board of director minutes, loan agreement, and other documents. Next, for the completeness of investment, the auditor can search for purchases of securities by examining transactions for a few days after year-end, and they can confirm security held by independent custodian, review and test security information to determine if all interest and dividend income has been recorded, as well as determine that all disclosure required by ASC Topic 320 and 321 have been made for investment. Besides, the completed financial reporting checklist to ensure that all financial statement disclosure related to investment are made. For accuracy, valuation, and allocation of investment, the substantive procedure that can be carried out are review broker invoice for cost basis of security purchase. The auditor can determine basis of valuing investment by tracing value to publish the quotation for marketable securities. They can determine whether there has been any permanent impairment in the value of the cost basis of an individual securities, and they can examine the sales of security to ensure proper recognition of realized gain or losses, and they also need to obtain a listing of investment by category, food listing, and agree total to security register and general register. For classification of investment, the auditor can examine an analysis of investment and related disclosure for proper classification. For presentation, the auditor can review disclosure checklist and related disclosure for proper classification, as well as read disclosure to ensure the information is accurate, presented properly in the appropriate amount, and that the disclosure are understandable. So that's all from me. Next, Zero will continue with his presentation.
Thank you, Chloe and Ziren. Now I will proceed to auditing fair value measurement. Fair value is defined as the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. As orderly transaction between market participants may or may not be observable at the measurement date, FASB ASC Topic 820 provides a hierarchy with three levels that distinguish the types of inputs used to value different types of assets and liabilities at their appropriate fair values. Level 1. Valuations are based on quoted prices in active markets for identical assets or liabilities, sometimes called marking to market. Examples of assets in this category include publicly traded stock, options, bonds, and mutual funds. Level 2. Valuations are based on directly and indirectly observable market data for similar or comparable assets or liability, sometimes called marking to metric. Examples of assets in this category include infrequently traded bonds and some mortgage and assets-based security. Level 3. Valuations are based on management-based judgment and involve management assumptions about how the market would price an asset or liability where the inputs are unobservable because there is little or no active market for the asset or liability being valued, sometimes called marking to model. Examples of assets in this category include long-term options, real estate, and private equity investment. In addition, there are four important areas in the auditing of fair value measurements from the more complete guidance provided in AS 2501 Auditing Accounting Estimates including fair value measurement. First, obtaining an understanding of how management makes fair value measurement. Second, considering whether specialized skills of knowledge are required. Third, testing the entity's fair value measurements. Fourth, evaluating the reasonableness of the fair value measurements. In order to plan the nature, timing, and extent of audit procedures associated with auditing fair value measurements, the auditor gains an understanding of the entity's process for determining fair value measurements and disclosures and of the relevant controls by considering factors such as the types of accounts or transactions requiring fair value measurements, the nature of the assumptions, including which of the assumptions are likely to be significant assumptions, how management consider the nature of the assets or liability being valued, including how and why they selected a particular valuation method or model, whether the entity operates in a particular industry where specific models are commonly used for fair value measurement. The extent to which the entity's process relies on a service organization to provide fair value measurements, the nature and extent of documentation, if any, supporting management's assumptions, the controls related to the review and approval of accounting estimates by appropriate levels of management and where appropriate, those charged with governance. The controls over how management determines the completeness, relevance, and accuracy of the data used to develop accounting estimates. Based on the understanding of management's processes and the risk assessment, auditors plan the nature, timing, and extent of the testing. Substantive tests of fair value measurements for level 1 assets or liabilities such as publicly traded stocks and bonds is relatively straightforward as market pricing can be easily verified by the auditor. Substantive audit procedures for level 2 or level 3 valuations such as complicated derivatives. So, how auditors going to test the entity's fair value measurements? First, testing how management make the accounting estimate. There are 5 ways to test how management make the accounting estimate, which includes testing whether the assumptions appropriately reflects observable market assumptions, testing management's assumption for reasonableness and potential bias, performing sensitivity analysis to determine the effects of changes in the assumptions on a fair value estimate, particularly for critical accounting estimates, testing whether management's rationale for the method selected is reasonable and is consistent with industry norm and the entity's own past history, testing that the underlying data used in the valuation method are accurate, complete, and relevant, is internally consistent with its use by the entity in other significant accounts, and has an appropriate source. Second, developing an independent point estimate or range for corroborative purpose. And third, reviewing subsequent events and transactions. As valuation models do not take qualitative factors into account when creating a fair value, uncertainty may arise for a variety of reasons, including the length of forecast and the subjectivity and complexity associated with the factors in the model. Given the inherent uncertainty in the inputs, valuation models rarely provide the correct or exact value and should be reviewed as providing a range of reasonable values, all of which should be considered in light of other industry and market information. After obtaining sufficient appropriate evidence through substantive tests, the auditor then evaluates whether management's measurements and disclosure are in accordance with GAAP. As capital markets continue to increase the complexity of financial instruments, it will be increasingly important for auditors to be proficient in understanding how fair value estimates are created and the impact they have on the overall audit plan. That's all from Group 7. Thank you for watching. Have a nice day.